Hey, everybody. It's your boy, Sean McLaughlin, at Option Sean on the old Twitter X. Today is Wednesday. What is it? November 5th, 2025. Hope you're doing well. This is the What Are My Options show. What are my options? What can I do here? This is just a kind of like an open office hours session where I can answer questions anybody has about anything related to options trading, whether it's a particular strategy that you need some honing in on, maybe some hedging ideas. We're going to talk about that a little bit. If you have a particular trade in mind that you need some guidance on selecting an option strategy to take advantage of your idea, that's what this session is for. I have as many as 30 minutes to hang out with you. We don't have to take all 30 minutes if we don't need to. But in the YouTube chat there, if you have questions, please type them in there. I will see them and I will do my best to answer them for you. Let's bring up my chart here, Gene. I'm showing the S&P 500 here, the SPY. Back, it's up on the day, back towards yesterday's highs. Just kind of in stuck in a little range here, kind of stuck in the muck. Um, who knows what's going to happen? We had a little fireworks overnight. I understand with some election nonsense, got everybody freaked out, and then of course we opened up the day basically where we closed it yesterday. I don't know how you guys pay attention to news and get freaked out by every headline. It's no way to live. I can't do it. I don't do it. I just follow price. And I woke up this morning and the price was telling me everything was fine. So how about that? Um, anyway, um, look, we've had quite a bull market. We've had quite a run off of the April lows, right? You can see it here in this chart. This has been an epic bull run. Are we running out of steam? Maybe. Maybe. I still think an end of the year face ripper is in the cards. I thought we officially launched it back here on October 24th and then coming in on that following Monday. I thought that was the launch of it. We've had a little bit of a false start, it appears. But man, it certainly feels like things are running out of steam, or maybe this is just rotation taking place. It's probably more the latter. And it's it's been tough if you're a momentum trader. We've had a lot of false starts and a lot of momentum trades. We have a couple that are winning pretty well. I mean, there's one trade that I'm in. I'll bring up this CSIQ. This thing's been ripping. I'm pretty pleased with this Canadian Solar. We'll see where it goes. I've got some November options. They expire in a couple weeks. But one thing that I've thought about while I wait for any questions to come in is hedging, how to hedge my portfolio. If you are like me and you have a lot of long exposure on the books, um, you might often be thinking about, well, man, if the market rolls over here, I could get torched or I could at least get hurt a little bit, right? And in a what are my options session maybe about a month ago or so, we talked about some hedging ideas. We talked about doing butterfly spreads out of the money, butterfly put spreads in, say, the SPX or the SPY or the QQQ. And that can be an effective put hedging strategy. But here's another one I want to throw at you. And this is one where it doesn't necessarily require the market to have any kind of rapid sell-off, but it might actually pay you pay you a little money if the market just kind of stalls and goes nowhere, right? Because as an options trader, if you're an options trader, sometimes, depending on what strategies you're using, of course, but if you have a lot of long calls, if you're in a bull market like we've been in, you have a lot of long call positions on or a lot of call vertical spreads, and the market is just kind of stalling. It's not really selling off, but it's not going anywhere either. Your positions are going to languish and they're going to lose money, right? Because theta is going to be dripping away every day and volatility is going to be coming out of those positions. That's going to hurt you, even though the underlying might not be doing anything. So, one way we can combat that is by selling call spreads in indexes. Now, a typical way, especially for a small account, might be to sell call spreads, call vertical spreads in the SPY. I don't prefer selling call spreads in SPY or QQQ, and here's why. if they go in your face, if the market keeps ripping, which is probably a good thing because you have a lot of long exposure on, it wouldn't be good for your hedge. But if the market keeps going up and you're short in the money calls on SPY or QQQ, you run the risk of being assigned against your position. Now, getting assigned against your position is not the end of the world, all right? But it introduces a little bit of headache. It introduces some risk. It introduces some added costs, added commission costs, and some brokerages charge fees for assignment. And these costs add up. So for me, when I'm using indexes as a hedge, especially if I'm hedging with short options that may or may not go in the money, I prefer the vehicle SPX. Let me bring up my other screen here. Let's bring up the SPX options. Now, SPX options are, you know, the bigger cousin of the SPY. In fact, it's the granddaddy of them all. This is the most liquid options contract on the planet, I believe. You know, maybe that's changed over the years, but it's certainly one of the most liquid. This is where this is an institutional playground, right? This is where institutions are hedging their risks. All right. Now, an SPX contract is 10 times the size of an SPY contract. Okay. That's important. Now, don't let that scare you. We can do spreads and define our risks. But one thing I love, the biggest thing I love about SPX is that it's cash settled. That means that your options, your short options could go way in the money, way in the money. It doesn't matter. You're not going to get early assigned. No big deal. What's going to happen is on expiration day, when those options expire, your account will be credited or debited, whatever amount is necessary for that spread. So for example, if I'm long a call, right? If I'm long, let's bring up today's options that expired today. If I'm long this November 68.15 call, which is just slightly out of the money right now, right? If SPX finishes the day at 68.20, right? I'm long the 68.15. If it closes the day right on the button at 68.20, those calls are $5 of the money. That means my account will be debited $5. $5 times 100, because that's how many that's the multiplier there. So my account will be debited or credited $500 after the close today. Conversely, if I'm short a 68.15 call and the SPX closes at 68.20 right on the button, then after the close today, my account will be debited $500. That's per one contract, right? So there's no guessing. There's no worrying about getting assigned stock and then worrying about the overnight risk of having that stock in your portfolio. None of that. It's cash settled. Now, there's also some tax advantages as well with trading SPX over SPY. We won't get into that. That's beyond the scope of what we do here. But SPX for hedging, to me, is a great idea. Now, here's an idea. What expiration you choose is up to you. Okay, it's up to you. But let's say let's sell an options contract expires 7 days from today, 7 days out, right? If I sell an at the money call vertical spread, let's sell the 68.15, okay, and go to and we'll do it $10 wide. Okay, so we'll sell the 68.15. We'll buy the 68.25. I'll get an approximately 580 credit for this trade. Okay, that's $580 credited to my account. Okay, and this is what the P&L graph of that would look like, right? Yeah. Let's clean this up a little bit. Let's do this. Yeah. No, I'm on the black. I'm showing my black charts. You can't see it. Oh, okay, guys, we're having a technical difficulty here. I apologize. Let's see. Let's see. Hold on. Am I not sharing my screen with you? Am I sure? Let me go into the Zoom settings here, guys. Sorry for the technical difficulties. I'm gonna, okay, I got you. I got you. I got it. Here we go. Now what do you see? There we go. Ladies and gentlemen, sorry about that. I was talking to Gene in the background. Yeah, I don't think you guys can hear him, but he's my tech guy. Gene, thanks for figuring that out for us. Um, okay, I apologize, guys. Anyway, here we are. SPX. We're looking at a P&L graph of a vertical spread, right? We're selling the 68.15, which is just slightly out of the money right now, and buying the 68.25. All right. This blue line shows the P&L on expiration day, which in this case would be November 12th. That's 1 week from today. The purple line shows how our P&L would trend over a range of prices. The x-axis is along the bottom here. Shows how it would trend today. So really what we want to pay attention to is the blue line. As long as we close below 68.15, which is a short strike, this 580 I'm collecting today, that's mine to keep. Now that doesn't require the market to crash. All it requires is the market to just not go higher, which if we're holding a lot of long positions right now, and the market's not going higher and it's just sitting there, well, we're going to like collecting this premium here, this 580 bucks per one lot. Now, it doesn't mean you only have to do one lot. You could do 2 lots, 3 lots, 4 lots, depending on the size of your account. Or you can go even wider. You could do a 618 or 68.15 call spread, or sorry, you could sell the 68.15 calls and you could buy, let's see, the 68.35 calls. All right, so $20 wide. You'll collect 1160 for that, or 1135 for that. Let's nail it down. 1140 you would collect, right? So prices are moving around. That's why you're seeing that. Now, of course, you could potentially lose as much as 860 bucks on this trade, okay? Because that spread could be worth as much as $2,000. That's the difference between these strikes. That's 20 bucks times 100. Yeah, times 100. It's 2,000 bucks, okay? That's the most it could be worth. But if you collect 1140 up front, then your net loss is 860. Okay. Now, it's important to remember with hedges, they don't always make money, and that's okay. In a perfect world, we don't want our hedges to make money. Why? Because that means our portfolio is likely performing very well. Okay. But we don't have to take a loss lying down with hedges. All right. One thing I like to do, and this can be aggressive to some people, but again, you're only doing this to balance out a otherwise long portfolio. In this case, I have a lot of long exposure, so I'm comfortable doing this. All right. So what you could consider doing is we've got a week until expiration on these calls, on this spread. Let's go back to the $10 wide spread because that's kind of more my comfort level. That's where I trade, right? So I collect 48 or 590 for this $10 wide spread. Well, let's put this. If I put the spread on today, great. I collected 590. I'm going to forget about it for the rest of the day. All right. Tomorrow, I'm going to log into my account, or I'm going to watch the market trade, and at some point after the market opens, I'm going to look at where SPX is, and if I see that my spread is now in the money. Let's say that the underlying has now moved. I'm going to see this. I'm moving on my chart. Say we moved up to 6,900, right? That's a pretty big move. If we move to 6,900, well, then my call spread is in the money, right? Well, what you can do is you could roll that call spread up, all right? I like to do it incrementally. I'm not saying this is the best way, but this is something that I do. It's something I'm considering doing more of actually. But you could roll this spread up where what you end up doing is you close that spread for whatever it costs, and then you sell the next week or the very next expiration out the next day. So in this case would be November 13th, but you move everything up one strike. So you're short the 68.15, right? Well, now I'm going to sell the 68.20 and the 68.30 to get long. So what I would end up doing is just moving my strike up incrementally, okay? And it would probably cost me, actually, this should be a sell, excuse me. This would be a sell. Um, we can't use these numbers because, the market, we're not there yet. But let's just assume, how do I explain this best? For me to close that spread that's in the money and then open up a new one strike higher in the next expiration series, it's going to cost me a debit. It might cost me 30 cents. It might cost me 50 cents. It might cost me 70 cents, somewhere in that neighborhood, right? But what that's done is that's given me another day for the market to roll back over. All right. And instead of Like if I collected 590 when I first got into the spread, and then I made that adjustment, this just closes out. This is confusing. And I made that adjustment and it cost me, let's say 50 cents. Well, that means I now am sitting with a credit of 540, right? It's the 590 I collected today minus the 40 cent adjustment I do tomorrow, right? So now I'm sitting on a 540 credit. And then if the market eventually does roll over and all those calls eventually expire worthless, I'm keeping 540 instead of 590. Still a win, right? So I could keep rolling these hedges up if I need to, as long as they're in the money. I could do that every day. Now, if we want to be aggressive, and this is something that I do occasionally, is if I have to adjust these spreads up and pay that debit, I will recoup that debit with a brand new at the money spread. All right. So again, let's say this is just for argument's sake. Let's say that we did move up to 6,900 tomorrow, and I rolled this spread up, $5, one increment, one strike. Well, then on that next day, I would sell that at the money strike, which in this case would be the 6,900. Again, we can't use these numbers here because we're not actually there. But let's go here. Sell vertical. I would sell the 6,900, just another vertical spread. I would probably get somewhere in the neighborhood of 590, which is what I got today for this one, right? And now I'm I have a 540 credit on that original spread, right? It was 590 when I got in. I paid 40 cents to roll it. So now I have 540 credit built in. Now I'm bringing in another 590 with a new spread. Now I have more risk on, yes. But the whole point of this, again, is a hedge, right? I want to be able to collect that money and keep that money if the market rolls over. It doesn't have to roll over far. It just has to stop going up. And eventually, um, this will work. Now, I'm doing this by the seat of my pants here, guys. I didn't plan to have this conversation. I don't see any questions coming in, so I just thought I'd talk about this. I don't have any like slides or better ways to describe this, and if you have questions, by all means, after this, you could always email me, Sean at allstarcharts.com, or hit me up on Twitter at options Sean. Happy to elaborate on this a little bit more. But the point of this exercise is that when we're short call spreads, right? We don't need the market to crash. This is just a hedge against the market sitting still or going down a little bit. If the market crashes, yes, we're still going to make money in these hedges and it's going to be great, but we're not going to make a lot of money. Okay? We're not going to make a lot of money. But hopefully, if the market crashes, you've got plans to get out of your other positions, and so you're getting out of that and managing risk that way. This hedge is really for markets that are going sideways, maybe moving up slightly and going down. That'll make money. All right. It's just one hedging opportunity. We talked like I said, a month or so ago about using butterfly spreads out of the money, put butterfly spreads to hedge against, like, say a 5% down move. Okay. The thing about options, as we talk about all the time here, is that options give us options. All right. There's lots of different ways to do things. This is just one way to hedge a portfolio, maybe a cost-effective way for some of you. But I would keep in mind, though, that if you're going to use indexes and if you're trading strategies where you're short options and you're worried that they might go in the money, find a way to do SPX and not SPY or QQQ, because those uh, just introduce different risks with assignment risks. I don't like, makes things uncomfortable and could lead to buying margin calls if you don't have enough capital in your account. It's just a headache nobody wants to deal with. Use SPX. That's what that vehicle is really for. Let's see. I have a question here from First Last. Boy, you got to figure out how to spell my name right, buddy. I don't know who that SHAWN guy is, but I'll let it pass. All right. Okay. What is your approach to determining the price to sell or buy puts and calls that are out of the money and in particularly have no open interest, low volume? Thanks and appreciate it. Okay. Well, first of all, I try not to get involved in options that have no open interest or low volume. That doesn't mean I'm perfect. I do occasionally get into options that have low open interest and low volume. Let's talk about that piece first. If I am willing to entertain the idea of getting into an option that has low volume or low open interest and perhaps a wide bid ask spread, I will get into the trade. I will only get into a debit trade where I'm long those options, right? Because when I'm long the options, I could define my risk. And I would be very careful to do two things. Number one, I would use a limit order to get into that option at the price that I'm willing to pay it, at a price that I think is fair. Okay. And I might have to let that order sit and work for a little while. I might need to let that thing cook before I get filled. I certainly don't want to pay the offer if I'm buying a call on a big bid ask spread, right? I don't want to do that. I want to maybe, put a limit order in the middle somewhere or maybe slightly below the middle and just be patient and let the market come to me. Okay, that's number one. And I need to know that what I pay for that option, I'm comfortable not getting that money back. I'm comfortable with that thing being a zero because of the illiquidity, right? I'm comfortable knowing that if this position doesn't work out and I have to take a big fat L and get zero back, that's okay. And the reason that's okay is because number two, I'm sizing my position accordingly, according to the risk I'm willing to accept. Okay. So, for example, if you have a $25,000 account, all right, I would be very uncomfortable risking more than, I don't know, 250 bucks. That's 1% of your account. All right. I don't want to risk more than 1% of my account on any one trade. All right. So if I have a $25,000 account, I don't want to risk more than 25 or 250 bucks. So my call that I'm buying, it better cost me no more than 250 bucks. All right. So that's it. That's how I manage the risk. Now, let's say that position goes my way, right? It's less of a problem if it goes your way, because if it goes your way and the options are still illiquid, you always have the option of exercising that call, taking ownership of the stock at that strike price, and immediately selling that stock. And that's how you can realize your gain. Some extra steps, it's some hassle, but it's okay. All right. That rarely happens again because I'm rarely trading options that have illiquidity, but I know that if it's a trade that's winning, and if I don't feel like I can get a fair price just selling the option outright, then I know that I could take assignment of that call. I could, buy those 100 shares and immediately sell them, and that's how I could realize my gain. All right. All right. The first part of that question was approach to determining the price to sell or buy puts and calls that are out of the money. Well, the way I determine my price is I want to look at the bid ask spread, and I ideally can get filled at a price somewhere in between. Like, whatever the bid ask spread, let's say this, the call is bid $1 and offered 110. Okay. That's 10 cents wide. A fair price would be getting filled at 105. That's right in the middle. So I might put a limit order in at 105. Maybe I'll put a limit order in at 104, 103, see if I can get lucky. And sometimes I do. It happens all the time. Or sometimes I'll just increase the best bid by 1 cent. So if the bid is $1, I might put in a bid at 101. Sometimes I get filled. Not always, but it's nice when it does, right? So how do I determine the price? That's how I determine the price that I'm willing to pay. I want to get filled somewhere in between the bid ask spread. I will rarely pay the ask when I'm buying a call, nor will I rarely sell the bid if I'm looking to short a call or put. Okay. I hope that answers your question. Ryan asks, I get it. Are you going to close these spreads when they gain 50%? Oh, we're talking about the SPX hedges. Yes. Are you going to close these spreads when they gain 50%, which you often do in other premium selling trades, or are you going to let them expire? That's a good question, Ryan. I think in this case, because these are hedges, I'm not really looking to just capture 50%. I might close them before they expire just to close them cheaply, just to get them off the books and remove the risk. But 50% is not my profit target in these spreads. I'm generally trying to get as much as I can. Again, because they're hedges, right? If these spreads are winning, it's likely because the rest of my portfolio is losing. So I want to squeeze as much out of these things as possible. But Ryan, nothing wrong with buying these back at half of what you collected. Nothing wrong with that. Or maybe being a little bit more aggressive, buying them back at 25% of what you collected. Um, Whatever you choose to do, Ryan, just, try to be consistent with it. I think as traders, anytime we can add consistency to what we do, it just makes us better at what we do. So Ryan, figure out what your number is or what your percentage is and go get it, or just let them expire worthless. Again, these are cash settled, so there's nothing really we need to do at expiration. If they close in the money, you'll just get the cash debited from your account, and you can go, then you can go and sell some new ones if you want and earn that cash back. But there you go. Ryan says, I never thought about using SPX, too large a dollar value. Thanks. The spread eliminates that problem. Yes, the spread does eliminate that problem. And yes, these are large contracts. I don't ever, I shouldn't say ever, I have, but I rarely just buy an outright SPX call or put or sell a naked SPX call or put. That just requires so much buying power, and it's way more buying power than I'm willing to risk on any one trade. But with spreads, you can define your risk, right? I mean, we're looking at $10 wide spreads here. $10 wide spread. I mean, the most I'm risking is in this case 410. The most I could lose is 410. I could even do a smaller spread, the 68.15, 68.20. It's a $5 wide spread, and I would collect 315 for that, meaning my max risk is is 185 or 185 per one lot. That's not bad, right? Most accounts can handle that. Okay, so yeah, Ryan, I would consider SPX, and you know what? I teased it a little bit earlier, but I'll mention it again. There is a tax advantage to trading SPX over SPY. They get treated as futures contracts, which is, I believe it's a 60-40. 60% of the gains are taxed as long-term capital gains, and which is lower, and 40% of the gains are taxed as regular. And I might have those numbers wrong. I'm not an accountant. I have an accountant who does this for me, and she knows what's up. But I could definitely say that there is a tax advantage to trading SPX versus SPY. All right, guys. Wow. Well, we covered some interesting territory here, and glad we had a couple questions come in. We are closing in on the 30-minute mark, so I'll just hang out here for another minute. If there's anything else you guys have questions about, I'm happy to talk about it. I see that the SPX is rallying, so that's good. That's good news for the market, I hope. Maybe this bull market is back. Yeah, I mean, we're still in the muck here. I'd like to see SPX get above 6,900 before I start thinking that end of the year squeeze is on. I still think we're getting that face ripper. I really do. I really do. All right, folks. I don't see any more questions coming in, so I think we're going to cut it here. Thanks for tuning in to What Are My Options? This is a show we try to do every week, Wednesday, same time, noon Eastern on Wednesdays. And I see Bob just has a question though. When am I coming to Chicago next? That's a really good question, Bob. I would love to get back to Chicago. I was really hoping I'd be going back for a Chicago Cubs World Series parade this week, but that's not happening. Bob, I have no plans at the moment to get back to Chicago, but maybe next summer I would like to get back there. I want to bring my son to Wrigley Field again. We had a great time last time we were there. And maybe we'll have an event out there, Bob. We'll get a little trader happy hour going. That would be awesome. Love to see you and love to see all of our friends out there in Chicago. All right, that's all I got for you, folks. Thanks for tuning in. We'll be back next Wednesday, noon Eastern, for What Are My Options? Come with your questions. We'll tackle some stuff. All right, everybody. Tune in tomorrow at 3 Eastern for the All-Star Options Jam session, where I will review action in the All-Star Options portfolio, positions we've exited, whether for a win or for a loss, any adjustments we've made for the portfolio. We'll look at what the market's doing, and we'll assess where we are. We'll update stops on existing positions, and of course I'll answer more questions if you have them. So please tune in tomorrow at 3 Eastern for the All-Star Options Jam session. All right, folks, have a great rest of your trading day. I'll talk to you tomorrow. Peace.